When economists look at a disaster, they don't look for emotions, they look for the data. And right now, the data coming out of the American tourism sector is flashing red. We are witnessing a textbook example of how a single bureaucratic decision can trigger a cascading economic failure. The subject of this failure is the new visa integrity fee, a policy that officially adds $250 to the cost of entering the United States. But to call it a fee is an economic understatement. In practice, it acts as a tariff on American small businesses. It acts as a barrier to trade for our service exports. And it acts as a poison pill for the one industry that cannot be outsourced: tourism. Today, we are going to conduct a forensic audit of this policy's impact across 10 major U.S. cities. We aren't just looking at fewer tourists. We are looking at the destruction of revenue streams, the erosion of profit margins, and the collapse of local tax bases. The projection is a staggering $21 billion loss in total economic output. That is not a rounding error. That is a recession-level event for the hospitality industry. Let's break down the math of this collapse, city by city, to understand exactly how a $250 charge creates a billion-dollar problem. Our analysis begins in Tucson, Arizona, a market heavily reliant on cross-border economic activity. In economic terms, Tucson is an export economy, where the product is the destination itself. Before this fee, the friction cost for a visitor from a non-visa waiver country was manageable. Now, with the total application cost approaching $500 per person, the price elasticity of demand has snapped. Data from local trade associations indicates a 32% drop in international visitor volume. Let's translate that percentage into hard currency. A 32% drop doesn't just mean empty hotel rooms. It means a 32% reduction in the cash flow that supports the entire local ecosystem. Tour operators in Tucson operate on thin margins, typically between 8 and 12%. When revenue drops by a third, those margins don't just shrink, they turn negative. We are seeing reports that 40% of local tour agencies have either halted operations or executed mass layoffs. This is the ripple effect in action. When a tour guide loses their income, they stop spending at the local grocery store, the local mechanic, and the local bank. The velocity of money in Tucson slows down, creating a localized economic depression in the hospitality sector. The visa integrity fee has effectively priced Tucson out of its own market. Moving northwest to Spokane, Washington, we see a different kind of market failure, a supply-side shock. Spokane's seasonal economy depends on a labor arbitrage model using J-1 visa holders. These are international students who come to work during peak seasons, filling roles that the local labor market cannot supply at the current wage equilibrium. The new fee applies to these workers as well. Economically, this creates a barrier to entry for the labor force itself. Why would a student pay nearly $500 in fees for a job that lasts only 3 months? They wouldn't, and the data proves it. J-1 visa applications for the region have collapsed by 40%. For business owners in Spokane, this is a supply chain crisis. Resorts and parks cannot operate at full capacity without this labor. One owner reported having to cap occupancy rates, not because of a lack of demand from domestic travelers, but because of a lack of operational capacity. This is an artificial cap on revenue. Assets that were upgraded with capital investment are now sitting idle, generating zero return on investment. When a business cannot sell its inventory, in this case, hotel nights and experiences, because the government has blocked its labor supply, that is a policy failure. Spokane is losing millions in potential revenue simply because the workforce has been taxed out of existence. We head south now to New Orleans, Louisiana, where the economic damage is hitting the event sector. Events like Jazz Fest are massive economic engines. They rely on the multiplier effect, where $1 spent on a ticket generates $5 in spending on food, lodging, and transport. But that multiplier effect is stalling. Ticket sales to international demographics have plunged by 40%. From a macro perspective, international visitors are the most valuable customers in the tourism ecosystem. They stay longer and spend roughly 3 times more per day than a domestic tourist. When New Orleans loses 35% of its international headcount, it is losing its highest margin customers. The street musicians and gig workers are the leading indicators of this crash. Their income is immediate cash flow from tourism. When that dries up, it signals a drop in discretionary spending across the board. The city's tax revenue, which relies heavily on sales tax and hotel occupancy tax, is facing a significant shortfall. This means less money for infrastructure, for policing, and for public services. The visa integrity fee is effectively defunding the city of New Orleans by choking off its primary source of external capital. Moving upriver to Kansas City, Missouri, we encounter a case of sunk cost risk. Kansas City is preparing for the 2026 World Cup, a global event that usually promises a massive return on investment. The city and private investors have poured hundreds of millions into infrastructure, betting on a surge of international liquidity. However, the new fee structure has fundamentally altered the risk profile of this investment. Current projections estimate a revenue loss of $200 million, specifically tied to the drop in international attendance. Let's look at the demographics of a World Cup. A huge portion of the fan base comes from South America and Africa, regions where the currency exchange rates already make US travel expensive. Adding a $500 entry barrier makes the trip financially impossible for the average fan. Tour packages from these regions are seeing cancellation rates of nearly 50%. This turns the World Cup from a windfall into a potential liability. If the hotels built for these fans remain empty, the debt service on those construction loans still has to be paid. Kansas City is staring at a potential solvency crisis for businesses that leveraged themselves based on attendance models that are no longer valid. The federal government has essentially devalued Kansas City's investment in the World Cup. Now we analyze the Florida market, starting with Miami. Miami acts as the financial and shopping hub for Latin America. The relationship here is transactional. Visitors come to buy goods, essentially importing US products back to their home countries. But the fee has acted as a tariff on these shoppers. Visitor numbers from key markets like Brazil and Argentina are down 40%. This has an immediate impact on the retail sector. Luxury malls and high-end restaurants in South Beach are reporting revenue declines of 20 to 35%. This is a massive contraction in consumption. When retail revenue drops, commercial real estate values eventually follow. We are looking at a potential correction in the Miami commercial property market if these tenants cannot make rent due to the loss of international foot traffic. The visa integrity fee is not just stopping tourists, it is stopping commerce. It is breaking the supply chain of customers that keeps Miami's economy fluid. Just north in Orlando, the theme park industry is facing a dual shock to both demand and operations. Orlando is a volume business. It relies on processing millions of people efficiently to cover massive, fixed overhead costs. The decline in J-1 visas has hit the operational side, forcing parks to cut capacity. Simultaneously, the price sensitivity of international families has hit the demand side. For a family of 4, the visa fees alone now equal the cost of a week's accommodation. This destroys the value proposition of an Orlando vacation. The economic model of the theme park relies on per capita spending inside the park. When you lose the international guests, who historically have the highest per capita spend on merchandise and dining, you crush the profit margin. The theme parks will survive, but the surrounding ecosystem of small businesses, the motels, the souvenir shops, the diners will not. We are likely to see a wave of small business bankruptcies in Central Florida as this policy continues to bite. Let's move to the heavyweight economic centers, starting with New York City. New York is the flagship of the U.S. tourism economy. Its tourism sector contributes billions to the local GDP, but even a giant can bleed. The city is reporting a significant drop in international arrivals, which correlates directly with a drop in Broadway ticket sales and luxury retail performance. The concern here is the loss of competitive advantage. Global tourism is a competitive market. London, Paris, and Tokyo are actively competing for the same high net worth travelers. By adding a significant cost barrier and bureaucratic friction, the US is voluntarily surrendering market share to its competitors. The data shows that travelers are rational economic actors. If the cost of access to New York becomes too high relative to the value, they substitute the destination. New York's tourism board is now fighting a losing battle, trying to market a product that the federal government has made prohibitively expensive. On the West Coast, Los Angeles is seeing its Pacific trade route severed. Tourism from Asia is a critical component of the LA economy, but the visa process for many Asian nations was already rigorous. The added fee has made it punitive. We are tracking a 40% decline in visitors from non-visa waiver countries. This impacts the entire entertainment ecosystem. Studio tours, which are high-margin products, are seeing lower volumes. But the longer-term economic threat is the brain drain in the creative sector. International students are a major revenue source for LA's film and art schools. They pay full tuition, effectively subsidizing domestic students and funding campus facilities. As these students are priced out by visa costs and discouraged by the hostility of the process, that revenue moves to Canada or the UK. Los Angeles is losing its future talent pool and its current revenue stream simultaneously. Finally, we look at Chicago, Illinois. Chicago serves as a case study in the failure of economic forecasting. City officials presented data warning of this exact outcome, but the policy was implemented regardless. Now, Chicago is realizing a 44% drop in international bookings. The architectural boat tours, a primary revenue driver for the Riverwalk district, are down by 50%. That is a 50% haircut on revenue for a capital-intensive business that has to maintain expensive vessels and pay high docking fees. This pushes many operators below the break-even point. If this trend continues through another fiscal quarter, we will see consolidation in the market, with smaller players being bought out or liquidating assets. Chicago's story proves that this is a systemic policy failure, where the revenue generated by the fee for the federal government is dwarfed by the revenue lost by the private sector. So, what is the total economic impact when we aggregate these 10 cities? We are looking at a massive destruction of value. The visa integrity fee generates a few $100 million for the State Department, theoretically, but in doing so, it wipes out $21 billion in tourism spending. The return on investment for this policy is catastrophically negative. For every dollar the government collects in fees, the U.S. economy loses roughly $100 in activity. This is bad economics. It is a policy that prioritizes administrative revenue over national prosperity. We are also seeing a distortion of the labor market. By cutting off the supply of seasonal workers via the J-1 visa fees, businesses are forced to raise wages to unsustainable levels or reduce capacity, both of which fuel inflation or reduce output. And let's not forget the tax implication. International tourists pay sales tax, they pay hotel taxes, they pay taxes on rental cars, they do not use public schools, they do not draw on Social Security, and they do not burden the healthcare system. They are pure profit for the American taxpayer. By driving them away, we are voluntarily cutting off a source of free tax revenue. The 10 cities we visited today are just the tip of the iceberg. The data is clear. The United States is becoming uncompetitive in the global travel market. We are pricing ourselves out. We are signaling to the world that we are closed for business. The chaos in these cities is not emotional, it is mathematical. When you raise the price of admission, fewer people buy a ticket. And right now, the US economy is paying the price for that lost ticket sales. Unless this fee structure is revisited and revised based on economic reality, the trend lines for 2026 and beyond point only in one direction, down. This is a wake-up call for policymakers. You cannot tax your way to prosperity, but you can certainly fee your way into a recession for the tourism industry. Thank you for watching this analysis. If you found this data breakdown valuable, please share it. The numbers don't lie, and right now, they are telling us a very expensive truth.